in terms of the reporting season, ratcheting down with analysts to where we are now below flat and we're at -3 or 4%. So actually, everybody, why we call it negative growth, I don't know. But we're talking about actual lower earnings and not just decelerating earnings growth. Your view is that we beat that and are able to post flat or just slightly higher or just flat with last year?
Yeah, just flat with last year.
Which would be a beat.
Exactly. So about a 3% beat. Our view is that expectations have been reset pretty sufficiently. So they came down about 7% in the 3 months before reporting season, which is a much bigger ratcheting down of expectations than you usually see. The good news is that when you've seen something that dramatic before, earnings have consistently beat expectations by about 3%. And when you look at a lot of the macro data heading into the quarter, some of the results from the early reporters, it would suggest that we should see something like flattish growth this quarter.
When did the stock market sniff that out, that it's not going to be as bad? Because it has had a great first quarter.
Right.
So did it looked past the forecast for down earnings and realized it's not going to be as bad? And also the flip side of that is you think we've basically seen the best for the year for the stock market.
Right. I think a lot of the optimism has really been around some of the green shoots we're seeing on global growth, optimism around trade, potentially looking past the earnings. I think what'll be key will really be management guidance this earnings season. We saw that come down over the past several months. Same thing with CapEx guidance. That's picked back up a little bit, but the uncertainty overhang has really been what, could affect earnings going out into the year if corporates are really uncertain about what's going on with growth and trade, have been hesitant to spend. So I think paying attention to what management's saying and what they're saying about the economy, what they're saying about China, could really drive stocks. And some of the areas that have seen valuations come down a lot, positioning come down a lot, like industrials, like tech, that have seen some of the bigger risks. These are the areas that we think could see some of the bigger reactions if they do see good.
So 3,000, you figure we might get a print like that on the S&P this year, but we don't necessarily stay there. And 2,900 is fair for 2019. Is that what you think?
Right. 2,900's been our year-end target. We've said that there's risk that the market could peak out somewhere around 3,000 this year. So it could potentially be a bit more upside, but we think that the risk reward for stocks from here is really, you don't necessarily want to buy the S&P 500 wholesale. You really want to focus on pockets of the market that are undervalued or where positioning's lower, or some of the cyclical areas that have been more beaten down that could see upsides.
Okay, David, your 2750 to 2950 range is for
now.
Would you call it short term or intermediate term?
For the spring.
For the spring. When is this? Spring ends in
June, late June, yeah. And I think 2750 to 2950 lasts basically till Labor Day.
2750 would get your attention. Well, that would be about a 7%.
We would jump on
about
that.
5% pullback between now and the summer. That wouldn't
I'm not
surprise
expecting
you?
a pullback.
You're
Actually,
not.
I think.
Then why put that lower point of the range in there then?
Because that's the fair value range.
Okay, 2750 to 2950.
2750 to 2950. I think by the end of the year, once we see signs in the third and fourth quarter that the U.S. economy is doing well and S&P earnings growth is back to 5% or above, I do think the S&P makes it to 3,000 by the end of the year, early 2020.
Does the economy need to improve globally to get back to 5% year-over-year growth, or are the comparisons easier?
I would say forget about acceleration, deceleration. The economy in the United States and the economy in China seem to be stable at very healthy pace of growth. Okay. And I'm feeling extremely good about the length of this expansion. I think it's going to be a 12 to 15-year expansion.
And where are we now?
I think we're in the 12th hole.
We're on the 12th hole.
I think we've got plenty of time left.
It was a bad one for some people yesterday.
Yeah, and I feel like people who were uncomfortable with this 10th year anniversary of the expansion should start getting very comfortable that the labor market's extremely strong. Last week we saw jobless claims at 196,000. It's the lowest in 50 years. And China is showing plenty of green shoots. The Fed understands that this is neutral for now. I think we've got a lot of good things happening here. We need to accept the good environment. And I think, yes, the S&P has a little bit of upside for the rest of the year, but it's got more upside over the coming years.
Really? Okay. So even 2020, election year, with everything that's happening,
right.
You still don't necessarily...
I often talk about this expansion being 12 or 15 years approximately in total. I think if we get through late 2020 and we get a political outcome that suggests there'll be no material increases in taxes, I do think this is an expansion that goes beyond 12 years.
Yeah.
If I just listened to what you guys were saying without knowing what your price targets were, ranges were, I would think that you would be expecting much more upside this year.
They sound fine, but they got
but then the price targets indicate not very
pretty
much
flattish.
more
Even
upside,
below where we are.
The risk reward is not there. I don't really get it. I mean, if I'm just an average person out there, I'm thinking, well, why should I be in the markets at all right now if you're telling me the upside is limited, the risk reward is not there?
Right. I think at this point it's really about picking your spots, because there are certainly areas of equities where we do see upside potential still. I think, healthcare is an area that we had recently lowered from overweight to neutral because, the risks that multiple see overhang as we head into the elections. That's an area
political risk for healthcare.
Political risk for healthcare. But there are areas of the economy like the consumer, as mentioned, that are still very strong. We had recently upgraded consumer discretionary to overweight. That's a sector where, wage pressures are still a potential headwind to margins, but it's also an area that typically underperforms later in the cycle when the Fed's tightening. So if the Fed's on hold in the near term and the consumer, we're still expecting a healthy backdrop, that's a sector that we do see upside in the near term.
And the upside that we're describing is healthy upside. Too many people have been waiting for this great pullback, and I think many of them even missed it back in December of last year. Be in the market. The market has healthy upside for the coming years. Pick your spots, as Jill's saying. We like emerging market Asia. We do like China shares quite a bit. And if you're still looking for something that has outperformance potential in the United States, big banks, we've been on top of growth stocks. We like them still. And I think they continue to outperform for the rest of the cycle. For the most part, I think it's the communication sector that has the most upside in the short term.
So what's known as FANG, basically.
It is basically that. Mm-hmm.